Order. Just before we go to the witnesses on the study of the Canadian real estate market and home ownership, we have a couple of budgetary items that we have to deal with. The clerk has handed those budgets around. The first one is a request for $23,900 for the study we're currently doing today. We need this money to pay those witnesses, etc. Does somebody want to move that budget? Moved by all those in favor? Opposed? Carried. The second budget deals with the cancelled study, or postponed study, onto the comprehensive review of the Canada's tax system. The clerk feels that the amount of $9,600 is high, but we do have an obligation to cover those witnesses who may have already purchased tickets, and there's cancellation fees. So do we have a mover for this budget as well?
Well,
Mr.
Since the government cancelled the study, I suggest they move that we cover those costs.
Postponed, Ron. Moved by Greg. All those in favor? Oops, question?
Yeah, just a question on that. So some people may have already expended monies, canceled their flights, and so we are going to be covering for that plus, or like, what exactly does this amount cover? And for
do you want to explain it, Susie?
It's the witnesses that we've already confirmed for next week's meeting. Those who have booked flights and things like that, where they'll incur a cancellation fee for canceling that, will cover for that. And all those witnesses will be re-invited when the committee undertakes the study again. But since the committee does reimburse reasonable expenses as per the policy for their travel arrangements, we have to pay for those cancellation fees.
okay, and of course we're saying we're very sorry. Is that correct?
Indeed.
Okay.
All right. All those in favor? Opposed? Carried. Turning then to today's agenda and the witnesses that are here for the study on the Canadian real estate market and home ownership. Thank you, all the witnesses, for coming, starting with the Canadian Real Estate Association. Mr. Simonson, Chief Executive Officer, and Mr. Cathcart. Go ahead, Mr. Simonson.
Thank you, Mr. Chair. The Canadian Real Estate Association would like to thank the committee for the opportunity to participate in the study on the Canadian real estate market and home ownership. CREA represents over 120,000 realtors from across the country. As one of Canada's largest single industry associations, we represent real estate brokers and agents, as well as home buyers and property owners throughout the country. Canada's housing market is a key component of Canada's overall economic stability, an important generator of jobs and economic security for the middle class. In 2016, each home sale generated over $52,000 in spin-off spending. This translates to one job for every 3 real estate transactions. In addition, resale housing transactions through the multiple listing service generated more than $28 billion in consumer spin-off spending and created more than 198,000 jobs in 2016. Most Canadians see their home as a source of pride, satisfaction, and accomplishment, not to mention a safe environment in which to raise their family, create happy memories, and create a sense of community. This is why CREA has been advocating for the indexation and modernization of the Home Buyers Plan, a program that allows Canadians to use their RRSP savings to purchase their first home. We were pleased to see that the plan was included in multiple election platforms in 2015, and we will continue to work with the government to ensure it remains a valuable program for all Canadians. As all real estate is local, it is important to note that the housing markets in and around Toronto and Vancouver have different realities compared to elsewhere in Canada, the vast majority of which are either well-balanced or amply supplied. It is crucial to consider and reflect upon different areas of the country when enacting policy that affects a wide swath of housing markets, including places not targeted directly by the government's recent regulatory measures. Consumer demand in markets like Toronto and Vancouver is at an all-time high, and there is significant shortage in housing supply. Various factors have caused an imbalance on the supply and demand of homes, which in turn drives up prices significantly. As this is a complex matter, CREA is encouraged that the federal government created a working group comprised of federal officials as well as provincial and municipal representatives. The three levels of government will be able to focus on the challenges in each region and recognize the local reality for all markets. While the provincial governments in Ontario and British Columbia have recently introduced measures to assist first-time home buyers, the federal government has tightened national mortgage rules, thereby lessening affordability for those seeking to enter the market. If the federal government continues to tighten mortgage rules, will this force provincial governments to implement further programs to assist first-time home buyers? CREA and its realtor members urge all levels of government to continue to work together to reach a healthy, competitive and stable housing market. We are prepared to share analysis of local housing market trends and apply our knowledge and data to help the government policymakers at all levels better understand how changes to housing market regulations may affect communities across Canada. Assistance for first-time homebuyers should be top of mind for all levels of government. First-time homebuyers need support to overcome the obstacle of saving for a down payment in order to reach their home ownership dream. The plan's purchasing power is steadily declining and has become less valuable due to the increase in home prices. We recommend the plan be indexed to inflation to preserve its purchasing power and continue to help first-time homebuyers attain home ownership. Easing affordability concerns is a key principle of the plan, and Canadians should be able to benefit from this program more than once. Canadians and their families who face sudden life changes such as job relocation, the death of a spouse, a marital breakdown, or the decision to accommodate an elderly family member may need support to maintain home ownership. Expanding the plan for Canadians to use their RSPs as a zero-interest self-loan is a fiscally responsible way to support families through a difficult period of change. In the last 8 years, the federal government has implemented 6 rounds of changes to tighten the rules for new government-backed insured mortgages and contain risks in the housing market. These measures have been implemented, some over a very short time period, and their full impact has yet to be determined. We recommend the government take a pause to fully evaluate the cumulative impact of the changes before looking at implementing additional measures. Thank you for your time. I would be pleased to answer any questions that the committee members may have. Thank you.
Thank you very much, Mr. Simonson. Turning to the Dominion Lending Centers, Mr. Morris, President, and Mr. Texera. I'm not sure if I got that right. Vice President, Marketing. Teixeira. Okay.
We're very similar, yes. Good afternoon.
Go ahead, fellas, you have the floor.
That's great. Good afternoon. Honourable members, thank you for the opportunity to contribute to this important work you are all doing. Dominion Lending Centres is Canada's largest network of accredited mortgage professionals with over 5,000 active brokers nationwide. Together with our affiliated companies, we facilitate approximately 38% of all mortgages brokered in Canada, more than any of the big 5 banks. At DLC, we pride ourselves on being both experts in finances of real estate and having our ears to the ground as it relates to the concerns of the Canadian consumer. Each year, our mortgage professionals work alongside lenders to provide Canadian families the opportunity to realize a dream, long-term financial security in a home. And before we begin, I want to make it clear that mortgage brokers are neither...
Morris, could I get you to slow down a little bit? The
Sure.
Translators are having some difficulty keeping up
I
with
always
the
speak
speed.
fast. Sorry about that, guys.
Not a problem.
Each year, our mortgage professionals work alongside lenders to provide Canadian families the opportunity to realize a dream, long-term financial security in a home. And before we begin, I want to make it clear that mortgage brokers are neither part of a big bank nor a monoline lender. Mortgage brokers originate 1/3 of all new mortgages in Canada each year. We provide competitive tension between lenders, provide choice and options for consumers, and serve not only major urban centres, but the small, underserved regional communities that make up the landscape of our country. Our job is to find the consumers the right mortgage for their family at the best rates. We are agnostic as to which solution is right for each family, and we are agnostic as to which lender funds that mortgage. We are, however, an authority on value. And what we find broadly is that a lot of the new rules that have been proposed here will drive down affordability. Our biggest issue with these proposals is that the government did not consult with our industry, our brokers, our monoline partners, our credit union partners, our two competitive insurers, our real estate partners, our housing partners, or anyone outside of the big banks for that matter. Policymakers did not have the benefit of our intimate perspective, and making these changes unilaterally will end up hurting all Canadians. These proposals skew consumers in the direction of the already dominant big banks. And while those may be viable solutions for some Canadians, many others, the monoline lenders, better fit their needs. When policy that's implemented favors the big bank, it reduces overall competition in the mortgage marketplace, and that hurts Canadian consumers, regardless of which solution they use for their homes. The other thing I want to emphasize before we begin is that these national scale changes are impacting the entire country when they are clearly directed at two hot housing markets, Toronto and Vancouver. We think that smart policy would be to implement whichever proposals are enacted on a regional basis, taking into account differences across the country. So while we understand and agree with the government's desire to protect consumers, Dominion Lending Centres disagrees with certain aspects of the recent mortgage rule changes as they make housing less affordable, not more affordable. Let's begin with the stress test. The net effect of the stress test on many homebuyers is that their purchasing power has now been reduced by upwards of 20%, which has significant impacts on not only first-time homebuyers, but many middle-class Canadians who need extra room for their growing families. In doing so, it makes housing less rather than more affordable. As a result, individuals and families who have had their purchasing power reduced have to look at purchasing condos with monthly fees or smaller homes in less desirable locations that require them to travel, commute to work and school. For others who now must postpone home purchases to save more money, they are falling further behind as house prices in many regions rise and they become further and further out of reach. We agree with government's core objective to reduce the risk of a major rise in defaults should rates increase, and we also agree that a stress test is the most prudent policy to achieve this. But what I can also tell you is that even with a hot housing market, there is a very low chance of the kind of defaults witnessed in the United States in 2008, given that the current default rates of less than currently 0.28%, that's right, just roughly 1/4%. So it's important to remember that when setting the rate at which the stress test is implemented. Restrictions on low-rate mortgage insurance eligibility requirements. Let's move to the restrictions on low-ratio mortgage insurance eligibility requirements. While traditional lenders, the big banks, have multiple revenue streams to finance mortgage loans, giving them the ability to effectively insure their own loans, the same cannot be said for non-bank or monoline lenders. Monoline lenders access funds through the mortgage-backed securities market, which can only be accessed with insured mortgages. They rely on portfolio insurance to finance their lending activity. As a result of the new requirements, investors are less inclined to fund monolines, who now must charge higher rates as investors expect a risk premium which must be priced in and passed along to the consumer. This again puts the banks at a competitive advantage as the monoline rates and costs go up. Mortgage credit availability is reduced to the extent that some monolines will now be forced to close or merge with other institutions, also reducing competition in the marketplace. Again, just like the new stress test rules, the net impact on the consumer is negative, making housing less affordable. Because the new rules prohibit insurance on non-owner occupied properties, there is an added strain on the already tight rental market, as those who invest in rental properties now face higher rates and much fewer borrowing options. We recommend the government reverse these changes or at least allow refinance mortgages and mortgages on homes valued at up to $1.5 million, given in some major markets homes over $1 million are commonplace and not a luxury to be portfolio insured. We would also be open to seeing the threshold reduced to a 75% loan-to-value ratio rather than removing eligibility for these products entirely. Mortgage insurance rules and lender risk sharing. We believe that a lender risk sharing program would raise the risk associated with funding mortgages and increase the capital lenders require. Again, while banks are sufficiently capitalized to retain loans on their books, smaller lenders are not, and thus would need to increase mortgage lending rates to offset additional risk, increasing costs to consumers. Even the banks are likely to pass off the cost of risk sharing to the consumer, increasing fees and mortgage rates, further reducing housing affordability. In summary, Dominion Lending Centres recognizes and appreciates the government's legitimate concerns regarding the debt load of Canadians and concerns relating to the housing affordability. Regardless of whether someone lives in the hot housing market like the GTA or in the prairies where house prices have remained flat for the past several years, it is important that when setting and analyzing housing and mortgage policy, to remember that 70% of households in Canada own their dwellings. Many Canadians are relying on equity in their home for their retirement cushion. By making housing less affordable and reducing demand, impacting home values, and skewing the market in the direction of the large banks, we are unintentionally making home ownership out of reach for many Canadians and more expensive for those already in their homes today. It will be a sad day when the government policy unintentionally lops off more than 20% of Canadians' net worth by hastily instituting policy that radically impacts one of the most admired housing markets in the world. As it pertains to mortgage rules and recommendations, and in addition to recommendations I've mentioned here today, we echo those put forward by Mortgage Professional Canada and many of the insurers, as well as the monoline lenders. We think that as an industry that handles more than 1/3 of all mortgages in Canada, it's important to consult mortgage brokers in advance and industry stakeholders before setting these types of policies. In summary, we have 5 proposals. Number 1, allow 12 to 18 months to study the impact of all changes made to date before considering any further changes. Number 2, modify the stress test to better reflect future rate expectations. Mandate that banks have to qualify all conventional mortgages at the same stress test threshold, eliminating the existing unlevel playing field. Given the number of further damaging consequences, do not proceed with the risk-sharing model. Number 4, reverse the decision and allow portfolio insurance on refinance and rental properties. If 80% loan-to-value is objectionable, reduce that threshold to 75% rather than removing that eligibility entirely. And 5, continue to work closely with other levels of government and industry to study and address individual housing markets at the regional level. The one last point that I would make that I think is pertinent is that it has to be, I think clearly understood by everyone that we are not against the big 5 banks in Canada. They're great partners to us. We do a lot of business. Matter of fact, we do more loan origination through them than any of their other partners. So we're on their side. And we've been very, very supportive of every mortgage rule change since 2008, more than 24 of them. This is the only time ever that you've made, changes unilaterally and very quickly without proper consultation that is having a massive impact on Canadians and their families. This is the only time universally that the industry has come together and said, listen, we want to at least provide our feedback because we think that there's been an error this time. We think that the policy is not prudent policy. So again, I'll wrap by thanking all of you for the opportunity, and thank you for having us here today.
Thank you. The Alberta Mortgage Broker Association, Ms. McDowell, President, and Mr. Mauji.
Correct. Yes.
Vice President.
Thank you, Mr. Chair. My name is Catherine McDowell, and I'm the current president of the Alberta Mortgage Brokers Association. With me is our past president, Adil Mauji, both licensed and practicing mortgage brokers in the province of Alberta. Also joining us is our executive director, Amanda Roy. We appreciate the opportunity to share our thoughts with this committee. The Alberta Mortgage Brokers Association is the oldest mortgage industry association in the country. For more than 40 years, AMBA has been the voice of the province's mortgage community, including brokerages, lenders, insurers, and industry service providers. More than 2,200 mortgage brokers representing 377 companies make their living in our province by helping Albertans achieve their dream of home ownership. Canadian mortgage brokers represent $80 billion in annual economic activity and are changing the landscape of mortgage borrowing for the next generation, with 50% of first-time homebuyers using brokers. In Alberta, our members contribute heavily to the provincial economy by arranging financing for new home construction, resales, and refinances for home improvement and debt services. Mortgage approvals alone in the province generated more than $30 billion as far back as 2010, according to Stats Canada. We are seeing firsthand the negative impact to the mortgage rule changes across Canada, especially to the Alberta consumer and economy. The unintended consequences of what we believe are mostly unnecessary changes at this time are resulting in a weakening of the middle class by transferring wealth in the form of higher interest costs and mortgage insurance costs for the consumer. Alberta has been the poster child for what regulators fear: 2 years of solid recession. According to the regulators, these changes were made to protect consumers from any impact resulting from higher unemployment rates or interest rate increases. We are not against a stress test in some form, although not as it currently exists. But our province has already been a test environment for the effects of unemployment. Prudent underwriting rules previously put in place for those very reasons have already given us the ability to weather that storm. In 2014, Alberta had an unemployment rate of 4.7%, and the number of households in arrears were 0.27%, which was just under the national average. By 2016, our unemployment rate had drastically increased from 4.7% to 8.5% by the fourth quarter, and the number of households in arrears was 0.41%. So an 81% increase in unemployment between 2014 and 2016 resulted in a relatively moderate increase in delinquencies from 0.27% to 0.41% in that same time period, according to CMHC data. At this time, we don't even know the impact of the wildfires in Fort McMurray in May of 2016, but according to that data, Q2 reported a 0.37% of delinquencies, and that number jumped those last few percentage points to 0.41 by the end of Q3. So we ask, what are these changes really protecting the taxpayer from? We consider the stress test to be a prudent underwriting measure to protect the Canadian taxpayer. However, we do feel the newly introduced qualifying rate and how it's calculated is too severe at 200 basis points higher than the average contract rate. For consistency across all mortgage applications and for consumer protection, we'd like the government to consider slightly tweaking the qualifying rate and how it's calculated in order to better reflect market conditions. As an example, a potential solution that could be explored is contract rate plus 1% to be applied across all mortgages. Other presentations to this committee have previously explained how securitization works, but what hasn't been explained is how it directly affects the middle class. Since October 2016, those attempting to buy a home without default insurance have been adversely affected by the transfer of wealth due to increased interest rates from this policy. This is also true for those refinancing. For example, a middle-class first-time buyer from 10 years ago who has equity in the home and needs funds to renovate in order to move his aging parents into a fully developed basement is forced to pay more to do so now. Refinancing for this purpose or for other investments typically helps build wealth in the household. The policy change of removing refinances from portfolio insurance will cost these individuals more through increased interest costs, resulting in a decrease in the potential middle-class wealth. Canadian consumers are now forced to pay more for their mortgages because of the new OSFI guidelines, which make mortgage insurance more expensive to the lenders. As a result of the requirement for mortgage insurers to hold more capital against the mortgages they insure, we have seen mortgage insurance premiums increase for both low and high ratio mortgages. The effects of this increase on mortgage lenders, both bank and monoline, has been to build that cost into the interest rate charged to the mortgage borrower. Today, we are seeing discounted interest rates on all high ratio insured mortgages. However, for any low ratio insured mortgage and any uninsured mortgages, the cost of implementing the capital requirements have been passed on to the mortgage borrower to bear by way of increased interest costs. Interest rates have been adjusted to reflect the added cost of portfolio insurance or the added cost of capital for lenders to hold these mortgages on their balance sheet. These increased costs have resulted in the increased Canada Child Benefit nearly negated in some cases. If a consumer claiming the Canada Child Benefit for a one-child family makes $90,000 a year, their tax savings would be approximately $1,120 per year. If they have an uninsured mortgage, they would have to earn nearly $1,100 more to pay the additional interest costs on a $400,000 mortgage. For the high ratio consumers putting 10% down, due to increased insurance costs, their future home equity decreases by $2,700, which is reflective of the amount of an extra premium on a $400,000 mortgage as well. In closing, there are 5 areas we would ask the committee to consider making changes to the new rules. We ask that you reconsider the re-inclusion of refinances in portfolio insurance. We recommend the modification of the current stress test to a more market plus approach. We ask you that you review the increase to the capital reserve requirements and ask more questions about how it was balanced. Alberta, for example, had a significant increase to unemployment, topping at 9%. What was the increase in losses year over year for the insurers? Was it proportional to the increase in insurer capital requirements? We also request a study into the potential effects of regional-based pricing for insurance and consider the effects of regionality as part of the risk-sharing model. We believe that over time, it will become very detrimental to Canadians in economically challenged areas where stimulus is needed, not added costs. In moving forward, we would also ask that the Alberta Mortgage Brokers Association, as well as all stakeholders who have testified to the Standing Committee on Finance, be considered key stakeholders to be consulted when reviewing all real estate finance changes in Canada. Thank you, Mr. Chair, for your time. We are prepared to take any questions you may have.
Thank you to all the witnesses. Given that we only got an hour, we will go with 5-minute rounds. That way we can get more people on. Starting with Ms. O'Connell.
Thank you, Mr. Chair. Thank you all for coming. Let me start off with some questions. Actually, I'll ask all of you, and it hopefully is a yes or no. The previous government implemented many changes to the mortgage market. There was changes in 2008, 2010, 2011, and 2012. Were any of you consulted prior to those changes?
I'll take a stab at that first. We were consulted via our associations, our large national association. In some of the situations, not every time, when it was around insurance portfolio insurance, as an example, that's something that they wouldn't necessarily reach out to us. But certainly, it is. As I said earlier, the changes this time are so much more categorically damaging than they've ever been before. So the changes in the past, we've never had this kind of pushback.
So let me then follow up, since you jumped in on that question with you. Is Dominion Trade or Lending Centers publicly traded?
60% of Dominion Lending Centers is owned by a publicly traded company. It's one company in a portfolio of many.
Would you not see a risk if the government made market-sensitive changes that could impact industries that were publicly traded?
I don't understand the question.
When changes like this are developed, there are market sensitivities. So an organization like yours, for example, that does have 60% openly traded, do you not see that there could be a risk for things like a shorting of stocks?
I mean, I think if you look at the mortgage landscape in Canada and any of the publicly traded companies, especially around the lenders, the monoline lenders, they have had severe pressure, and some of them have had much short selling pressure over the last 12 months. I don't necessarily see how that ties in. I mean, we're talking about mortgage policy that's going to affect all Canadians now. We're talking about policy that is overreaching in an effort to cool down Vancouver and Toronto. It would be the equivalent of being a school teacher and having 2 misbehaving, students, one named Vancouver, one named Toronto, and punishing the entire country. Doesn't make sense.
Thank you. So let me follow up on that line then. These regulations and these changes actually are trying not to cool down markets, but actually limiting risks to those that are higher debt levels. It's not, the changes do not go into effect one way in one region and another way in a different region. It's the debt ratio, not price or value of home, it's debt ratio. So if you have low debt in a household in Alberta, but high debt in Ontario, that's what is the factor here, not the value of your home. So let me just follow up in terms of, you say overreach. The Canadian government helps and supports mortgage companies and lenders more than Australia, the US, the UK. If the Canadian government no longer, with taxpayer money, no longer backed your insurance, would you be able to operate under your business model without the support of the Canadian government?
If that happened, all you're going to have is the big five charter banks in the country, and you're going to have devastation among monoline lenders, credit unions in the country. You're going to take away the entire focus around free trade and competitive nature. What you're actually doing by doing that is you're favoring a monopoly, a government-favored monopoly in the country. And just so you know, in 1987, it was actually CMHC who realized this, and the government who realized these deep compressions and the difficulty that we were having around the competitive landscape. And in fact, that's when they came out and they, developed, new lending criteria and gave additional lenders the ability to insure mortgage loans so that they could have other alternatives of funding.
Sure, but it's certainly, Mr. Chair, it would be certainly prudent that since we're using taxpayer dollars to support that competition, that it's prudent that we then support and limit risk in those insurances to those higher risk borrowers who have high levels of debt to ensure that their investments, sorry, I didn't have a question yet, that those investments are actually protected in an industry to ensure the competition can continue. You can't have one without the other. And so remember, we're using taxpayers' money here. And my last question to you, sir, is where is the evidence?
Keep it quick if you can.
Thank you. Where's the evidence that you have, and if you have it, if you could submit it to the committee, where's the evidence that you have that people have actually been pushed out of the market?
I can give you hundreds and hundreds of letters, emails, phone calls. More than 100. We're seeing it, every month where people, are writing to us saying they can no longer qualify. They were close. They were two teachers. They had been saving for 5 or 6 years. They finally got where they, to the point where they had a down payment to qualify. And then all of a sudden, these rule changes came in, and the mortgage amount they thought they were going to qualify for was no longer available to them. So A, they couldn't qualify, so they had a choice. Can't live in the city where I actually go to work and raise my kids and where our children go to school. I got to move 30 or 40 or 50 kilometers out, or I have to not get into the, the housing market at all. And I want to make one point, and
I want to clarify.
We're going to cut it there.
I just don't know if he's saying they were pushed out or just not qualifying for the amount they thought they would. Because my question was about being pushed out of the market completely. Those were his
if you want to answer that in the next rounds of questions, go ahead, Mr. Morris. Mr. Deltel.
Thank you, Mr. Speaker. Mesdames, Messieurs, soyez les bienvenus dans votre Parlement.
Ladies and gentlemen, welcome to Parliament. I'll continue in English.
Asking you any questions, gentlemen and madam. Just want to make that I'm very pleased to see how cautious our colleagues from the government party are so prudent when they talk about debt and they talk about limiting the risk, while this government, if nothing changes, will go to a debt of $1.5 trillion in 2050. So what is good for Canadians will not be good for Canadian government. We have to be more very concerned with that. So, gentlemen, madam, just a question to everybody of you. Were you consulted before the call of the minister in October?
I'm sorry, I didn't hear
No, we were not consulted.
No.
Mr. Morris?
No, we were not.
Madam?
No.
When were you informed, and how were you informed of the call of the minister?
Via email.
Sorry?
Via email
Email?
and
Okay.
media.
Email from the minister or from?
Oh, CMHC sent out.
Okay, so you're working well.
An email to the industry.
Okay.
Sorry, an email to the industry is how it was communicated to the broker industry.
Yeah, most stakeholders in the Canadian housing market, realtors associations, monoline lenders, the two secondary insurers in Canada, the large distribution networks were notified via the media announcement.
Mr. Simonson?
Same.
Okay, so thanks. We have a good media people to inform you of the major decision. And as we had said a few minutes ago, Mr. Morris, it has huge impact. So we all recognize that we have a difficulty situation in Toronto and Vancouver. Gentlemen and Madam, you said quite clear, crystal clear, that the new initiative didn't address the average people who want to buy their first house. But at least, can we say that the announcement of October was good to address the problem that we had to face in Toronto and Vancouver? Mr. Simonson.
Just to make sure I'm understanding the question, you were asking if the mortgage rule changes that were made in October were helpful to the markets in Toronto and Vancouver? Well, certainly they had some impact, and one of the reasons why we've stressed about the importance of expanding the home buyers program for those individuals who would be impacted by it. It allows them to apply some additional funds to qualify under the revised mortgage rules, under the stress test, and be able to hopefully qualify for something where they've got a higher down payment, less interest payments that ultimately they're having to pay, and also not having to then go through the cost of mortgage insurance. So it would certainly have an impact in that regard.
Positive one?
No, it would not be a positive one in that circumstance, no.
Okay. Mr. Morris?
Yeah, I mean, you know, I don't know that they necessarily had a positive impact on Vancouver and Toronto. I mean, you know, a lot of these policy changes really impacted first-time homebuyers, and a first-time homebuyer today isn't a 19, 20-year-old kid, you know, trying to trick the bank into, you know, giving them a mortgage loan. The profile of a first-time homebuyer is a young family, typically between the ages of 25 and 40. They have an incredibly high Beacon credit score, averaging 752. They have a household combined income of between $80,000 and $100,000. These are real people that are raising kids, that, you know, make sacrifices to their community, that, you know, coach other children. And it was targeted at those. And when I tie that back to Toronto and Vancouver, those first-time home buyers, they're, you know, for the most part, invisible in those markets. They're not buying in Toronto and Vancouver. They can't buy. The houses are so out of reach. They're buying in Chilliwack, they're buying in Guelph, they're buying in secondary markets. So did it have a positive effect? I'm not sure that the intended you know, tools that the government implemented did much at all to really improve Toronto or Vancouver. I think what the provincial government did in British Columbia was very prudent. It was very regional, and I think it had a very quick impact. And that was positive.
So, at least if all those new rules could have a positive effect on Toronto and Vancouver, at least we could say, okay, it was not so bad. But what I understand of what you're saying, gentlemen, is that no good effect, neither in big city, neither for the average Canadian. Mr. Simonson?
Well, I think that's one of the themes certainly you've heard here today, is take a pause. We need to assess what is truly the impact, to look at the data, to look at the consequences in the marketplace, and to let that play out and see what are the results of it. And it's too early to understand what truly those results are, and if you're going to be a data-driven organization and base decisions upon facts and upon data, then let's make sure we've got that together. And that's certainly one of the reasons why we've strongly advocated take a pause. Let's see what the impact is, not just in Toronto, Vancouver, but across the country.
Mr. Caron.
Just to be clear, because Ms. McConnell asked the question, but you weren't informed or consulted for this round of changes. Is this usual? Are you usually consulted with regard to this kind of changes to the mortgage market?
In most cases, it is constant or common knowledge or common behavior for government to consult the industry. I can speak on behalf of Mortgage Professionals Canada, whom you guys have seen earlier as a witness here in this committee. On a regular basis, they were consulted and did lobby in Ottawa and did have representation, speaking with the ministers in previous government, unlike these last changes where no one was consulted.
So it's usual for you to be consulted and seek to be consulted?
National Association, and yes, they usually are.
In many of the changes in the past, we've been consulted via associations who have worked with the Department of Finance. Prior to this previous government, our association, our industry had a very, very good working relationship with the Department of Finance and with Ottawa and the regulators, no question.
In terms of all the previous changes, I can't state categorically that we were consulted on all of them, but there was certainly some consultation on prior ones, but not on the most recent.
Okay. Follow up on that, and I'll not take from your time, but what's been going through my mind, when there's a lot of secrecy around a budget, and there's very good reason for that. On this specific decision, was it not important to, I guess, not let out of the bag in any way the decision that was going to be made and its impact it might have on the markets? Was there a valid reason for not, on this specific question, consulting with the industry in terms of what that might do to the markets?
Absolutely. I can speak on behalf of Albertans. My colleague Katie spoke and testified that for the past 2 years, Alberta has been suffering. Unlike the rest of Canada, we were a hot market for many, many years, and for the past 2 years, we've seen the complete opposite, a reversal of our fortunes. And what these new rule changes have done are just kicked our province while we're down. There's no better word for me to explain it. It's we've pushed out, to answer your question, Ms. O'Connell, I'll say the bottom 20% of home buyers I can speak on behalf of Calgary, as they just cannot afford to buy in Calgary because there are no homes priced at under $150,000 when they were previously qualifying for a $225,000 to $250,000 condo. They're being forced to go back and enter the rental market, where we are even seeing higher vacancies due to lack of jobs. People can't afford to pay rent. They're moving back in with their families. We're seeing multi-generational housing being the forefront of, I can speak on behalf of my business, where I'm 32 years old, and they're moving in with their parents, and their parents are legalizing their suites.
Adele, though, that's the consequences of the decision. What I was asking is...
I was explaining the reason why we should be consulted.
In terms of the secrecy around the decision, that may have been necessary.
I still feel that you can speak to associations in confidence. If you needed to close the meeting, I still feel you need to be able to consult professionals, because we are experts in our field and we're here for a reason.
Okay, that's fine. You have 4 minutes left, Guy.
Thank you. On this, I would say that the finance minister actually consults regularly prior to budgets to get information. Doesn't mean that the measures will be in there, but if he wants to actually have a measure in the budget, he might actually ask questions about that specific measure to some stakeholders as well, which is, I think, the point we're trying to get across here. Quickly, especially for those who are involved in the Toronto and Vancouver markets, I guess it's too early right now to say what the consequences are in quantitative terms. You agree with this? It's too early to say. We have an impression it might actually be, might be efficient, might not be efficient, but we can't really say at this point. We'll have to wait a bit. We agree. One thing, though, is that in BC, we also all agree that those were 2 markets that were overheated, and we don't even know if it constitutes a bubble or not. The question I have is, we've seen in Vancouver measures, provincial measures, including a special tax for foreign buyers, that seem to have deflated the market, just hopefully to a point where it might be seen as healthy. We'll see about that. In Toronto, I would say it's a bit stabilized right now, but it hasn't decreased per se. Do you have the feeling that the provincial measures will actually be more efficient than the federal measures that were announced recently in trying to address that situation? Just for those situations, regardless of what will happen in the rest, because we all agree that the rest of the country is actually different markets that will be impacted differently. But for those 2 measures, those 2 markets.
Just speaking of the Vancouver marketplace, certainly based upon our data analysis, the market was already starting to slow down before any of the measures that were taken in BC. So how that would have played out is difficult to predict now because those measures have been taken. And again, back to the importance of let's analyze exactly what the impact is.
Before you answer, I just want to tell you where I want to head with this is the fact that we're in a bit of a conundrum because we're seeing that provincial measures might be more efficient than federal measures because they don't cover wall to wall, basically. On the other side, those regulations, CHMC, banking regulations, are federal in nature. So what should the federal do in terms of trying to ensure there's no formation of real estate bubble in some markets? And how much power should be given and what type of power should be given to the provinces to address those local markets and the situation in those local markets more adequately?
Do you want me to jump in, or do you want to finish there?
Sure. I think it goes back to earlier comment made about the collaboration between all three levels. When you look at Toronto and Vancouver, we know that supply is a big issue, and that's not obviously an area of federal responsibility. That's one more at a provincial and a local level. But we think that there are some opportunities there for that kind of collaborative effort to make sure that whatever policies are adopted, both federally, provincially, and municipally, are complementing one another and not competing with one another. We think that's going to be and we were very encouraged by that initiative. So I think, number one, we would certainly suggest that is a very important approach to take.
Would you say that this collaboration is lacking at the moment?
Don't know. We know that there has been two groups formed, and we've not been privy to the reports or the work of that, other than the fact we were certainly encouraged that initiative was taking place.
Yeah, as Gary just mentioned a few minutes ago, back in April, Vancouver, started coming off month after month after month after month, and I think that the tax on the vacant properties in Vancouver was very prudent. I don't even necessarily disagree with the foreign home buyers tax. Certainly in those urban large centers, they were driving up prices. There's no question. I fully support the federal government working with their provincial counterparts to take a regional approach in markets as they become problematic. And, again, just to reiterate, from my perspective, I'm in a very unique, position. I'm not a lender, I'm not an insurer. I'm an originator, and I can shift my business. I can just send more of my business to the banks. I have great relationships with them. I'm just universally just giving you, someone who looks at 400,000, more than that, almost 500,000 mortgage transactions, applications per year. I'm just sharing just boots on the street, real feedback. And, the changes that were made by this government was without consultation and very quick. And we all know in the industry that the attempt from the government was just to solidify our Canadian housing market so we continue to be, that country that, worldwide markets look to for, with admiration. They just, on this particular situation, I think went a little too far.
We'll have to cut you both there. We have time for two more questioners, Mr. Sabera and Mr. Albas. Mr. Sabera, 5 minutes.
Thank you, Mr. Chair, and welcome everyone. This is the third session I believe we've had on the housing market, and we've heard some great testimony from everyone. I'd like to make a couple points before the question. Firstly, in Canada, we have a 69% home ownership rate, which is pretty good if you compare it to across any G7 country, or if you want to lump in a few other countries. So a very high and healthy home ownership rate. We have a lot of people, about 40% of the market, that actually don't have a mortgage. Another great thing, we don't have some of the lending, we've never had some of the lending practices that they had in the United States. Ninja loans, adjustable rate mortgages loans, collateral that was really never there. If you've ever watched The Big Short, that's basically true. Everything that happened in that movie, that's basically true. I lived it and saw it.
Betcha.
So we have a very resilient housing market, but we also have CMHC, which is effectively backstopped by the Canadian taxpayer. So any government, conservative, liberal, needs to be prudent. In my comment in the last session, I said, isn't it prudent when CMHC is effectively backstopped by the taxpayers of Canada to implement measures designed to improve the quality of indebtedness for borrowers going forward. I think, me myself, it is prudent for any government, be it on the Liberal side or in the past on the Conservative side, to do so. I continue to believe that, and I think many of the measures that were introduced by the federal government, be it Liberal or in the past Conservative, because the changes started under the past administration, that are prudent and need to be put in place. So I want to make that remark, because I think it's important to be on the record. We're not trying to not have people enter the housing market. We just want to make sure that the level of indebtedness is manageable. We do have regional markets, I agree. Now, on the consultation point, I remember in my past life that the past administration made a big change to something called the income trust market. And they announced it at about 4:45 p.m. after the market closed, and basically that market collapsed. And income trusts at that time were a pretty popular thing for a lot of companies to do, distribute cash flow to shareholders and so forth. And the market basically collapsed. And it was a promise that they broke. The Conservative Party broke that promise. They said they would never tax income trusts, and they did. Okay? They didn't consult. So, particularly when it impacts the prices of publicly traded securities, it affects behavior. Okay? So, on consultation is important. I agree, I get it. But when certain measures needs to be introduced, when there is an impact, and when there will be an impact on market behavior, individual behavior, sometimes measures need to be introduced. So let's put that on the record. There is one question, I will end this off. Thank you, Mr. Chair. Good. Thank you. Is the pause. A lot of participants have asked for a pause in terms of further measures being introduced, whether it's risk sharing or other measures, and who knows what they may be or may not be. What timeline would we be looking at for individual market? I do want to add one thing. For the folks from Alberta, I hear where you're coming from. I grew up in a small town that was devastated by a pulp mill closure. The folks in Saskatchewan right now and Newfoundland and Labrador that are being impacted by the low commodity prices. You know, my hearts go out to those families that are impacted, and our government's doing everything we can to get those people back to work and make sure middle-class Canadians have a good future in this country. So I do want to add that. But in terms of the pause, how long of a pause would we be looking at?
I'll take that one on. So I think that a pause in the range of 12 to 18 months to review the existing changes would be prudent. I want to just maybe make a comment on one of the comments that you made as well when you talk about the high debt load of the Canadian consumers. So, about 74% of the Canadian consumer high debt load right now is housing debt, is mortgage debt. So 73% actually. So 27% is outside debt, credit card debt, unsecured line of credit debt, auto loan debt. Debt that is frankly, anywhere from sort of 4, 5, 6, 8 times at a rate 8 times of their mortgage debt. And because we see so much activity, that is the debt in this country. When we see families stretched and not being able to put food on the table and looking to sell their homes or refinance their homes, is usually to retire that high interest debt at 16, 18, 19, 20%. And I get it. You know what? It's not backstopped by the government, and it probably isn't for this forum right here. But when I look at the disproportionate share of Canadian debt to income right now, much of it is that debt that, as I said, is 5 times higher than the mortgage debt. So I'd like you to keep that in mind.
I'm going to have to cut you there, Mr. Morris, or we'll not get Mr. Albaz in. So we'll have to go to Mr. Albaz's question, and Mr. Simonson, if you want to answer that pause question, try and fit it in one of these answers.
Sure. Thank you, Mr. Chair. I just want to quickly address the point about consulting and publicly traded companies and how that might impact and all that kind of thing. Most of us, at least that were there on the call in Kelowna, we were just before doing pre-budget consultations, heard directly, because Mr. McColman asked specifically, did you consult? And finance officials confirmed that they did not do a formal consultation. They said we would not call it a consultation, but we did discuss it with some banks. So, Mr. Chair, for anyone to say that that this is all about keeping that protection so that no one gets an advantage of it, that's ridiculous. We heard that, and I would just refresh that into some people's minds. Consulting can be a very good thing. Yes, We did take some measures after 2008, which many people pointed out to me was the ultimate stress test. And we hear from Ms. McDowell today. She says 81% increase in unemployment in Alberta, and going from, I think, 0.26% for default to 0.41% of 1% default shows there's a huge resilience within the system. So anyway, for people to be saying this is about debt, you know, the system itself, because of the prudence of the people in the business, is what is given us such a good system. And yes, some adjustments could be argued, you know, weren't always well received by the industry. They have said themselves they have never seen this. So I'm going to get right into my parts right now. So first of all, we talked about refinancing and how many mortgage loan companies may not be in that market anymore because of the increased cost of a refinance. I've talked to a credit union. They've seen that they've seen an uptick in second mortgages. Now, to me, that's concerning. A second mortgage puts a person in a much more precarious state to achieve the same goal. I'm going to ask Mr. Morris, since you know, your mortgage brokers do about 39% of the business. Have you seen anything?
Yeah, I mean, you've nailed it. You know, bang on. You know, unfortunately, these changes make it much more difficult for our monoline lenders, the lenders that actually, you know, develop and compete and keep a competitive landscape. The inability to refinance, or if they can refinance, they have to do it at a substantially higher cost now. So, you know, the biggest impact that we see is the suspension of the ability to portfolio insure. So what's happened because of that, you know, I could give you an example. On the secondary financing space, what we call the Alt-A mortgage space, second mortgages, private lenders, mortgage investment corps. 3 or 4 years ago, about 3% of our overall national volume was done through these channels, and you know, today it's 12%. So it's growing very quickly. So because we're making it more difficult for Canadians, you know, our kids that you know are out there just trying to retire some of that high interest credit card debt, that's usually what they're refinancing their home for, you know, or to maybe help their child go to university. They're actually going to secondary finance sources at rates of 8, 10, 12.
So people are still getting into debt.
It's actually costing them much more.
People are still getting into debt, but they are paying much more for it, and it's putting them into a more precarious state because second mortgages, you know, are very, very expensive. Is that correct?
Yes.
Okay, so you would say that the refinancing policy has not achieved its goal. In fact, it's actually pushing people into more precarious positions. Is that correct?
Yeah, I mean, the biggest thing this government could do is reassess and review that portfolio insurance. Just changing that, you know, one dynamic itself, going back and allowing portfolio insurance so that monoline lenders can provide refinancing would make a tremendous improvement and a huge difference to all the competition in Canada.
Okay, so I have a quick question. We had Carolyn Rogers from OFSFI come in, and she told us that OFSFI's policies are regionally neutral. So it's my understanding that when the new capital requirements, they specifically use location in their formula. Is that correct?
It is, yeah.
So what are we not getting here? Because they say it's regionally neutral, yet they take and assess as part of the formula where a home is located.
The costs are not regionally neutral. The costs are spread across the country. Alberta may have a lower risk than BC, but it's the same cost to refinance a home, an uninsured mortgage to, or purchase a home with 20% down or more for somebody from British Columbia as it would be from Alberta or anywhere else in the province. The cost to the consumer is the same.
We're going to have to end it there. Mr. Simonson, you wanted in on the pause. If you could limit it to 15 seconds.
Thank you. Just wanted to comment that certainly our outlook would be, you're talking at best case starting in the summer where we'd be able to have the data to really assess what kind of impact these changes have made.
Okay, thank you all for your presentations. We will suspend for a few minutes while the next witnesses come to the table. Thank you all for your presentations and your direct answers. Order. The clock is ticking. We will start with Mr. Brewer and Mr. Landcastle. Sorry. With the Appraisal Institute of Canada, Mr. Brewer, President, Mr. Landcastle, Chief Executive Officer. Go ahead.
Thank you. Thank you very much, Mr. Chairman, honourable members, ladies and gentlemen. My name is Keith Landcastle. I'm Chief Executive Officer of the Appraisal Institute of Canada. Joining me is our National President, Dan Brewer, who is an AACI PAP qualified, fully designated member of our association from the Toronto area. We are very pleased today to present our members' concerns and recommendations to the Standing Committee on Finance as you consider issues around the Canadian real estate market and home ownership. The Appraisal Institute of Canada has over 5,200 members who provide unbiased opinions of value on residential, commercial, and all other types of real property. Our members are university educated and complete a rigorous program of professional study. The scope and the conduct of our member services are defined by our Canadian Uniform Standards of Professional Appraisal Practice. As a self-regulatory body, we have a strong focus on consumer protection. We maintain a robust disciplinary process and offer a mandatory professional liability insurance program to help protect consumers. AIC is very supportive of the Office of Superintendent of Financial Institutions Guidelines B20 and B21 and some of the other more recent measures that have been implemented to help stabilize the Canadian housing market. Today, however, we would like to discuss two areas of concern. First is the risk of potential dilution of sound mortgage underwriting practices across the marketplace. Our second concern is in the area of the increasing potential for and risk of mortgage fraud. In the area of sound mortgage underwriting practices, we know that the majority of Canadian mortgage lending is still being done through federally regulated institutions. But the market share of non-federally regulated financial institutions continues to grow. The inherent risk is that the mortgage underwriting practices of these two categories of lenders may be inconsistent and may, over time, result in a two-tiered lending system. The reality is that despite federal policies and procedures to cool the real estate market, there are still many Canadians who are very desperate and determined to enter or remain in the housing market. Some existing homeowners now find themselves in the situation where they must consolidate their debt. In either situations, if a borrower is turned away by a federally regulated institution, they are more likely to look towards other lenders to secure mortgage funding. We recognize that non-federally regulated financial institutions are a very important part of the market. However, in some cases, these lenders serve a cohort of the Canadian marketplace and Canadian consumer base that may be higher risk in nature. Unfortunately, there is limited information available on the full scope of who these lenders are or what their mortgage underwriting practices may be. Put another way, there is a growing share of the market that is not necessarily competing on the same basis and for whom the same regulatory oversight may not apply. This scenario, in our opinion, is a potential risk to the financial system and to the housing market. The absence of a level playing field could well have an unintended impact on the market. One, by essentially increasing the indebtedness of Canadians. Two, higher risk borrowers entering or remaining in the market, which exacerbates issues around housing demand. Three, increasing vulnerability or increasing likelihood of mortgage default in the event of a decline in the real estate market. We are aware of non-federally regulated lenders that apply very stringent underwriting approaches, both in terms of borrower qualifications and of collateral valuation. We are concerned, however, with the actions of lenders that may have less rigorous approaches to mortgage underwriting. B20 has established a very sound and balanced framework that is recognized as a world leader that requires assessment of not only the borrower's capacity and willingness to repay, but also a commitment to strong valuation fundamentals. As we have seen in other countries, the absence of a balanced and consistent approach can and will have a significant impact on the consumer and on the real estate market as a whole. Like many of the other organizations that have appeared before this committee, AIC agrees that there is a need for the Government of Canada to take time to analyze the impact of recent policies before implementing new regulatory measures. That said, AIC is also recommending the expanded application of B20 and B21 guidelines, as well as the newly announced or more recently announced measures to any and all organizations that are providing mortgage financing. This step will do much to ensure more consistent lending practices and make for a more stable marketplace. Secondly, AIC would like to express our concerns around the potential increase of mortgage fraud. This concern is supported by a recent Equifax study that revealed that instances of mortgage fraud in Canada have risen along with the escalating prices in the Toronto and Vancouver areas. Equifax has noted that, quote, the number of potentially dishonest mortgage applications has grown by 52% over the past 4 years, end quote. Appraisers have the expertise to raise red flags in a real estate transaction, helping lenders better detect any potential mortgage fraud concerns before they occur. On-site appraisals carried out by qualified professionals are an effective way to help all parties involved in mortgage underwriting to detect fraud and to better mitigate lending and property investment risk. To that end, our recommendation is that all organizations involved in lending work together to better detect potential incidences of fraud. Government can encourage and potentially facilitate sector-wide dialogue and engagement on this topic. Mr. Chairman, honourable members, we are privileged to have been invited here today and to share the perspectives of our members. We appreciate the chance to share our recommendations and would also be very pleased to respond to any questions or comments you or your colleagues may have. Thank you.
Thank you very much, Keith. The Quebec Federation of Real Estate Boards, Ms. Guy and Mr. Cardinal.
Thank you, Mr. Chair. Bonjour à tous. Good afternoon.
Good afternoon, everyone. First of all, allow me to introduce us. My name is Penela Guy. I am responsible for the Quebec Federation of Real Estate Boards. I'm accompanied by Paul Cardinal, who is responsible for our market analysis service.
For the opportunity to appear before you today on this very important matter. La Fédération des Chambres immobilières du Québec.
Our federation is a non-profit organization regrouping the 12 real estate boards of Quebec. Our organization contributes to defending, protecting, and promoting the interests of real estate brokers in the province. And we offer services with regard to professional standards, public affairs, and market analysis. In 2016, the some 13,000 brokers we represent negotiated more than 79,000 real estate transactions, representing an economic impact estimated to be worth $2.9 billion.
To address concerns raised by the Vancouver and Toronto markets, we believe it is important for committee members to understand the negative impacts the recent tightening of mortgage rules will have on the Quebec real estate market.
Indeed, we're predicting a drop of approximately 7% of residential sales in Quebec in 2017. These are mainly buyers who have less than 20% down payment affected by the new mortgage rates, so mostly first-time buyers. This crisis should, in our estimation, evict from the market between 5,000 and 6,000 Quebec buyers in 2017, equivalent to some $220 million in spin-off expenditures. Furthermore, since the purchasing power of several households will be eliminated with the stress test, we're predicting that the price of properties will not rise in Quebec in 2017. The Quebec market is very different from those elsewhere because in Quebec the context of the real estate market isn't the same, mainly for three reasons. First of all, the price of properties is much more affordable than in other Canadian provinces. In 2016, the average price in Quebec was of $281,000 compared to $471,000 in the rest of Canada. Even in Montreal, where the average cost is $350,000, we can compare ourselves advantageously with the average cost of properties in Toronto, which is of $730,000, and in Vancouver, it is close to triple that, in other words, more than $1 million. Here in Quebec, the lowest prices are such that excessive indebtedness is less of an issue. Secondly, far from being overheated in many regions, the conditions of the real estate market in Quebec let us lead us to believe that there is an imbalance in favor of purchasers. For this reason, the price of properties only increased by 5% from 2012 to 2016. With the changes and the tightening bringing the amortization period down from 30 to 25 years. So we got a soft landing, but some measures might be very harmful. And we must remember that houses are the main asset of most households. Thirdly, Quebec is lagging behind other Canadian provinces with regard to ownership rates. Only 61% of Quebec households own their home compared to 70% or more in all of the other Canadian provinces without exception. However, the new mortgage rules in place since last October will create, or rather put the brakes on, home ownership. For example, before October 17th, to qualify for a $300,000 loan, a household had to have a gross annual income of around $59,000. Today, they must have an income of about $72,000. This example illustrates well how the stress test will remove an important number of potential buyers in the middle class. There is this stress test that forces lenders to pay higher rates, and you must add to that the fact that there have been 3 increases in the mortgage rates over the last 4 years and a reduction in the competition. These 3 factors joined together will prevent many young households from realizing their dream of home ownership, contrary to the generations that preceded them. In conclusion, we have 2 possible solutions. First, as recommended by the Canadian Real Estate Association, the Association des Professionnels en Construction du Québec, we're asking the government to enhance and to improve the home buyers plan.
A task force to look into not only future changes to mortgage rules, but all types of consumer loans. Nous offrons d'ailleurs, en terminant, notre entière collaboration au gouvernement sur toute question.
In conclusion, we're offering our entire cooperation and collaboration to the government with regard to areas affecting the real estate market, and we're now at your disposal for any questions. Thank you.
Presentation and your suggested recommendations. Turning then to the Urban Development Institute of Nova Scotia, Mr. Graham. The floor is yours.
Thank you, Mr. Chair and honorable members. We're pleased. I'm a board member of the Urban Development Institute. My name is David Graham, and I'm also a developer in Halifax. The Urban Development Institute board represents predominantly developers of either land, rental, condo, home building. In Halifax, we have experienced a decrease in the sale of new homes, single-family home, detached homes, over the course of the last 4 years. And what had predominantly been a market of 1,000 homes a year has decreased to a low in 2015 of 425 to this past year of 550. And it might be the result of a variety of reasons, some of which are that we have an aging baby boom population that's moving into rental accommodation. We have immigrants that are coming in, moving into rental, and millennials at this point can't seem to get into the market the way they would like. I think it's worth noting that 45% of the resale transactions in Halifax are for less than $250,000, and 75% of the housing resale transactions in Halifax are for less than $350,000. I emphasize that number because we're not Vancouver and we're not Toronto, and we don't want to have regulations imposed upon us that might be partly or entirely geared towards correcting a housing bubble in both Vancouver and Toronto. And to that end, we'd like for the Finance Department to acknowledge or appreciate the, and I'm sure they do, the very diverse and different markets that exist across the country. While there are imbalances in the Canadian housing market, Halifax is a very stable market and relies on first-time home buyers to get into the market so as to generate a second round of home purchases, and in time a third round, and so on. Decreases in the number of first-time home buyers in the market has a negative effect on, and that will exacerbate a market that CMHC already categorizes as weak. Because we believe we have a balanced market, if the Finance Department is concerned about certain markets, and I emphasize Vancouver and Toronto, one way to avoid painting the secondary markets with that broad brush might be to properly apply regulations on home prices. Namely, we could potentially have a tiered system, and it's a recommendation on our part for Finance Department to consider tiering such that the stress tests and new mortgage rules wouldn't apply to homes that are under a certain value, and I'll pick $350,000 for the sake of the argument. And in so doing, the policy will not be detrimental to markets that are currently in balance and they predominantly be secondary markets. I point out that the National Housing Act was expanded in 1954 to make home ownership more accessible to Canadians. New rules and modifications consistently reinforce this objective over time. In 1999, the National Housing Act and CMHC introduced a 5% down payment plan, removing a significant barrier for first-time home buyers. Now, if I can draw on a hypothetical scenario, if defaults represented 0.5% of the market, and we wanted first-time home buyers to start asset accumulation at a young age in these low interest rate environments, then in the hypothetical, out of 200 mortgages that would be recorded, 199 people would have the opportunity to be in asset accumulation at this historically low interest rate times. One person would default. The questions that we would like to ask of the Finance Department, if you'd be kind enough to supply them for us, can you provide more evidence on how you arrived at your conclusions to put new mortgage rules in place? Does data exist that follow the success of the National Housing Act regulations in 1999, or the failure, as the case may be, of their initiative to have a 5% down payment plan? Is there data that can compare any notable change in default rates as the result of this initiative, or conversely, the number of first-time home buyers this initiative was able to get into home ownership? And finally, in the context of getting first-time home buyers into asset accumulation in the form of housing, have you modeled the consequences that comes with the number of first-time home buyers who are not able to buy a home, and what their alternative spending habits are in the absence of such a forced savings plan? Thank you for your time.
Thank you very much, David. And we do have officials before the committee on Monday coming, so I guess you can look at the record then and see who will win the star from the committee's members here who asked that question. Right, Mr. Dittel? Sure. Turning to Mr. Fergus, 5 minutes.
Thank you very much, Mr. Chairman, and thank you to all of the witnesses here today. This was very interesting. I found that your presentations are very intriguing, clearly. Before beginning with my questions, I would like to underscore this. I'm looking at my colleagues from the official opposition who purport to be the great defenders of the middle class, and this is why they voted against several measures to reduce taxes, to help families, etc.
Mr. Dittel, then with Mr. Sabara. We're not going down this line again.
I couldn't hold back, Mr. Chairman. Forgive me. I move to my questions now. In particular, Mr. Cardinal and Ms. Guy, and then Mr. Brewer and Mr. Lancaster. When my wife and I were young, we were new university graduates and we started our first jobs. We bought our house. We made a down payment of 25%. Those were the rules at the time. It was in '95. And for us, well, we were looking at the market, the real estate market, its situation, and we said, okay, we didn't earn big salaries, but we were able to seek out a mortgage. It wasn't insured. It was a normal mortgage. So we made a choice to leave the rental market instead of renting an apartment. We moved to the purchase of a home, a house. That choice was normal because we looked at our finances. I understand full well that it's important to leave a lot of room for first home buyers to make room for them. But I must put the question, is it a good thing to admit into the market people who are perhaps in a more precarious financial situation than 5 or 10 or 15 years previous to that? Thank you, Mr. Fergus, for your question. With regard to the quality of lenders, I believe that a lot was done. A lot has been done for several years with the 6 rule tightenings we've seen in the last few years. When lenders show the ability to pay back when they have a good credit rating, the 5% minimum down payment seems to be a measure that to date has allowed people to access ownership, to purchase a home without having us find ourselves in more situations of default. Because the first factor for determining default is to determine one's ability to pay based on your credit rating and your income. But let's refine this. It's preferable to have lenders, or rather borrowers, that are much more solid, that can better resist exogenous factors that can arise all of a sudden out of the blue. For example, if interest rates jump up, all of a sudden, it's preferable. Yes, it is preferable, but for example, if the criteria are too stringent for people to purchase their first home, then we'd be preventing people from owning their home. And it's easy to demonstrate throughout the whole period for which we have data, the last 35 years. This data shows that those people who have become homeowners have improved their financial situation thanks to this forced saving mechanism and the value gained by their property over time. So they've improved their financial situation and their asset base much more than those who continue to rent. Another question. I don't know how much time I have, Mr. Chairman.
Très rapidement.
Very quickly. Is the market admitting more people into it now, today, than when I was 25 years old in 95? Are there more people who qualify for mortgages today in present-day circumstances? In fact, compared with 1995, I can't really give you any guarantees. Generally speaking, well, before 2008, it was easier. Today, the criteria are stricter, more stringent than they were at the time. But even with that severity today, it seems that the market, well, it is such that there are an awful lot more people in the market today than 25 years ago or even 20 years ago. As for the number of people who want to buy, yes, the demand is stronger, namely because we have lower mortgage rates.
More time.
Mr. Leibert.
Yes, thank you all for being here. And I just have one question. I'm going to share my time with my colleague to the right. For the witnesses, you're the last group of witnesses we're going to hear. Those of us on this side of the table would have liked to have heard more, but your evidence has been so compelling that I think there were some people at the table who've heard enough. Let's say that. The two gentlemen to the right of the chair are analysts, and they take the evidence that's presented over the course of all these hearings and go away and write a report and bring it back to the committee. So I thought maybe what I would do in my question is summarize what I think I've heard, and I'd like each one of you to comment, and it might give our analysts a good running start on preparing their report. This is what I think I heard, and I would ask each one of you to if there's things in this that aren't correct, please say so. If this pretty much summarizes where you feel you're at, I'd like to hear that. So what I've heard is there's been no consultation by government with stakeholders. The changes to the mortgage rules significantly reduced the number of people who are eligible to purchase homes for the first time. The government implemented a one-size-fits-all model to try and fix problems that are primarily in Toronto and Vancouver. Communities outside Vancouver and Toronto are seeing fewer sales, especially to first-time home buyers, fewer housing starts, increased pressure on the rental market due to the inability that first-time home buyers can buy a home. Fewer people are buying homes, thereby fewer homes are being built, which is actually reducing jobs in the country and not creating them. Arrears and delinquencies in home ownership are not a cause for concern in our country. And frankly, the government should admit it made a mistake and reverse the decision made last October. I would appreciate comments on that.
Mr. Lancaster.
Thank you very much, Mr. Chairman. What our organization would say is that we believe that Canada's real estate market has been exceptionally well served by the regulatory framework that has been in existence. We have the opportunity to interact with our colleagues internationally and have observed what's happened in other real estate markets when the fundamentals of mortgage underwriting are askew. When there's an emphasis that does not place, when the process does not place adequate emphasis on the borrower's capacity and willingness to repay, higher risk borrowers enter the market, which can have disastrous implications. Our organization is perhaps somewhat unique in that our members have no vested interest in the outcome of the transaction. We're focused on the health of the marketplace, up markets, down markets. It is our contention and our belief that the consistent application of the type of regulatory framework that's existed in our country would continue to serve Canadians well and the marketplace well. So that would be our comment in response.
Ms. Guy, go ahead.
We're going to share the answers to your to your questions or statements. I have to agree with you that there was no consultation prior to making the decision. When you talk about the fewer number of first-time buyers, we've heard that it may be a little early to really come out with strong and reliable statistics. What I can tell you is that what we're hearing from our members on the ground is that, yes, there are a lot of people who were in the process of looking at homes and wanting to become homeowners that have decided to wait and postpone their decision for later.
To add to my colleague's response, with regard to the activity, indeed it's too early to tell. With the November, December, January results, we haven't yet seen any drop-off impact as to the number of real estate transactions, but we're expecting that there will be a different situation. The spring is the period of the year when first-time buyers are most present in the market. But with the tightening that we saw in July 2012, where we saw the amortization period, the maximum, fall from 30 to 25 years, there was a drop of 8% of the resale numbers in Quebec, followed by a smaller drop in 2014. So this does show that there was an impact on the market. In our opinion, it could be similar this time around, similar to what we saw in 2013. You talked about mortgage loan default or arrears. In Quebec, it's 3 mortgages out of 1,000 that are in arrears of more than 90 days. And as I said earlier, if we're trying to project ourselves into the future to see what's the determining element here with regard to the evolution of this variable, first and foremost, it's having a job more than interest rates. It's your income. So when the job situation isn't good, that rate increases. But it wasn't necessarily correlated to increases, major increases in mortgage rates.
Mr. Graham, do you have anything to add?
Yes. I mean, I can't comment on your many questions, but I think that it affects our local market, and every market is regional. And our market is a secondary market. It's very, very different than Vancouver and Toronto. And to prevent our first-time home buyers from getting into the market, as I mentioned, has that second round and third round effect, which is not good for our economy, not good for home ownership. I would like, the predominant question that I would like to ask is what happens in the alternative of first-time home buyers not being able to put a mortgage in place and have a forced savings plan. What are their spending habits? Are they spending it on an expensive car? Are they spending it on vacations, which I think is a great way to spend your money? But are they being frivolous with their money? Are they not starting asset accumulation, which I think is very important? And I don't think that with regards to high household indebtedness, it's much more difficult for us to comment on that. But I think that if I were to take the value of a home and the substance of a home in Canada that's backed by rigorous mortgage regulations, it can't be compared to the United States, because in the United States at one time they could self-assess, they could be 0% down, they could write off their mortgages, they could buy several homes at a time. So it's a very, very different market. So
Okay.
I'd simply like those questions answered.
Thank you. Thank you all. Turning to Mr. Caron.
Merci beaucoup. Madame Guy.
Thank you very much, Ms. Guy. In your recommendations, one of your recommendations that you put forward is that you improve the buyer's plan, the home buyer's plan. Could you explain how you'd like to see the plan improved? Well, our federation, the Quebec Federation of Real Estate Boards, supports the request made by the Canadian Association. One of the ways of improving the plan would be to broaden the eligibility rules in order that people might be able to use available income to invest in real estate. With regard to specific measures, I don't know. Maybe you'd like to add something, Paul? But we're also supporting the APCHQ measure that they outlined to you so that there can be intergenerational assistance for parents who want to help their children buy a home. That's another example of the way it could be broadened. There was also the idea of having measures for those who divorce or lose their job. So those are improvements that could be envisaged. Indexation as well would be an important improvement because it hasn't been done for a long time. Have I forgotten something, Paul? No. The APCHQ, when they came here, they put several questions on the floor in a previous session. I am in favor of this. I think it's basically a good idea, but there can be abuse, as with any good idea. Reports came to us with regard to potential abuse with this plan, the home buyer's plan, and this happens when a spouse might give RSP money or room on their RSP to their spouse, allowing the other spouse to purchase a property, and that money isn't reimbursed. So there's a second property that belongs to the family, the household, but they're two distinct individuals, and it isn't necessarily reimbursed. If it isn't, it's taxed, but if the spouse doesn't work, it's a tax rate of 0. So you've got two homes, and you got credit from a single credit source, and it seems that we're seeing this happen more and more. My fear, if indeed it's true, and I'd like you to confirm it to me if you've heard about this kind of occurrence, my fear is that the use of RSPs given to children could be used in the same way. So perhaps you could respond to these concerns I have, because I deem that the plan, with regard to its role, its mandate, is interesting and important for first home buyers. I would just like to ensure that it isn't used badly. It is difficult, or would be difficult, for me to judge or comment on this concern overall. What we can say is that we consider that home ownership is very important, and this tool allows people to purchase a home. I think that in any government decision, there must be controls put in place. I can also tell you that based on what our members say, the situation you've just explained or outlined isn't one that's brought up regularly. Might someone else have heard comments about this in Nova Scotia or elsewhere? Assessors? No? Another question that I have asked previously, and any one of you could respond, but I'll begin with Quebec. Clearly, the matter of market overheating, the hot markets out there, it's a priority, and that's the reason why the government addressed this. The overheating impacted mostly on Vancouver, Toronto, and Regina, not really Montreal or Quebec City. And the markets are going to suffer there, and you mentioned this. The problem is that when we talk about banking rules, mortgage rules, this is under federal jurisdiction, but Quebec would be in a better position to come forward with its own solutions. How could we ensure that Quebec and Ottawa work better, more hand in hand, or same thing for Halifax or the rest of the country, to ensure that we can respond to the overheating of the market without having an impact on the other markets? We often say this in politics when it's local. Well, it's local. It's about the same for real estate. Real estate is local. Mortgage rules and regulations come under federal jurisdiction. In this area, as in many others, the federal government can work with provincial authorities, even municipal governments, in areas where there are regional disparities like this that occur. I don't know if, Paul, you'd have anything else to say, but the idea is to continue to look at the impact, analyze the regional impact of the decisions made. That would be my suggestion.
Mr. Lancaster? Castle?
Just simply to say that, while real estate markets are local, there's interaction from national level players, provincial level players, and local level players, and it's important to engage all of those in developing solutions that respond to markets, whether they are particularly heated markets like Toronto and Vancouver, or other markets that may be facing some challenges or are more stable. Unfortunately, it's a very complex set of interactions, but again, we fall back to the base principle that the regulatory framework that's been in place federally has served the Canadian market well. And building on that seems to make sense, and history has shown that it has worked well in all Canadian markets across the country.
Thank you all. Mr. Greywell.
Mr. Chair, and thank you to the witnesses for coming today. The purchase of a home is the most important purchase that any Canadian citizen will make. I still hear stories about how my parents, saved and saved and saved and bought their first home in Brampton, and they also complained about the double-digit interest rates they were paying in the early 90s in the housing market and the concerns that they had back then. On a regular basis, the housing market doesn't come up in my neck of the woods except for how hot it is, and there's a shortage of supply, and that's driving up the prices of homes, and people are concerned about that. But even people that have paid off their mortgages, their house is still their number one asset, and they're still concerned about the overall housing market, and they don't want what happened in 2008 in the United States to happen in Canada. My question really is on the appraisals, because I've been hearing feedback and you're the only witness that's brought up the concern of mortgage fraud, and that people, and this comes to the appraisals as well, is that homes are being overappraised so that you're qualifying for a larger mortgage. And then couple that in with the mortgage fraud, you're stretching yourself you're very, very leveraged. And I feel like that's the biggest concern in the market, and it's something that's not visible. So your comments on that would be really appreciated.
The issue of mortgage fraud is also very complex. We are aware from interactions with our members of situations where they've actually prepared an appraisal report, and somewhere along the road, the base amounts have been altered. So hypothetically, a member prepares a report valuing the property at $750,000, and at the time of mortgage origination, the report has been altered to $850,000. So in that case, in those types of scenarios, in fact, our members are collateral damage, if you will, to the fraud. They're unwillingly involved in it. What we are able to do through the appraisal process, though, is to help identify some of the potential red flags. For example, our standards require our members to provide a detailed 3-year sales history of a subject property. So if there are incidences such as flipping that are creating a fraudulent situation, those can help raise red flags. Certainly we can do things like identify the occupancy of the home. If the property is being appraised as a owner-occupied development, and you find out when the appraiser arrives that in fact the owner is not occupying the development, that too is information that can provide insight to the lender to help address fraud. When we're looking at the 52% increase that Equifax quotes, I think it's important to recognize as well, though, that mortgage fraud is a very broad term, and it can be, I've heard it phrased as shelter fraud, where I provide a gift letter to my children indicating that there's no expectation that they will pay me back, but behind the scenes they have every intention of paying me back. Now, they're doing that to acquire shelter. They're not doing that to defraud the system, but technically and notionally that is in fact mortgage fraud. So it's good to have the understanding. Appraisers can be part of the process in addressing that. Again, there are numerous examples that we've been informed of where our members have been collateral to that, but again have not been involved in the process, but have found out later in the process that in fact their work has been doctored to help perpetrate a fraud.
From a practical perspective, so let's say somebody comes and you appraise the home, and your appraisal report, does that go directly to the mortgage? So would it go directly to the bank?
It depends on who your client is, so it really depends. In most cases, it will go to the lender because they'll be the intended user of the report. They'll be the ones who rely on it.
So, and what would be another scenario, like the real estate agent gets it?
Highly unlikely. In most cases, it is prepared for the intended user, which would ultimately be the client, who would be the lender, typically.
And is it rare for the lender to call and to verify the report, or do they take it as, we have this report, it's a checklist on our required documents, and that's the end of it?
Many lenders have safeguards and policies in place where original documentation must be received from the appraiser. And so, in fact, there is some safeguards, electronic signatures, digitally secured. There are some mechanisms with respect to policies that they have to protect that process.
One of the efforts that our organization has been involved in, for instance, is working with lenders to help them better understand how they can look at appraisals and make sure that there has not been a fraud perpetrated as a result of it. Just some of the things that they might want to potentially consider.
Does any of the other witnesses want to add a comment on this segment? We're out of time. David?
No, I'm fine.
Okay. Mr. Albas.
Appreciate that, Mr. Chair, and I want to thank all of our witnesses for being here today. And I really hope that when we had OFSV and we had Canadian Mortgage and Housing Corporation, they never used the word fraud once. So I hope that the government members aren't trying to spin any of this about these rules are put in place to prevent fraud. However, I'm going to I'll actually go right to Mr. Landcastle. Appreciate you being here. Page 3 of your briefing note says, despite federal policies and procedures to cool the real estate market in recent years, there are still many Canadians who are determined to enter the housing market. If they are turned away by federally regulated institutions due to the newly implemented policy and OFSI regulations, the unintended consequences may be that borrowers are turning towards less regulated, including second-tier lenders, to secure funding at a higher interest rate. Now, in the earlier session, I asked specifically, because I've heard from a credit union that they're seeing a large uptick in second mortgage activity. So is that the kind of behavior you're talking about, sir?
Anecdotally, our members are informing us that they are now seeing an increased level of activity in appraisals for second mortgages. That seems to coincide with the introduction and the change in some of these requirements. It's for that reason that we believe that all organizations that are involved in providing mortgage financing, whether it be first, second, or third, should comply with the same level of rigor in terms of the assessment of the borrower's capacity to pay and the valuation of the collateral. The concern is there are people in the second mortgage space that apply very, very stringent underwriting criteria. That is not the same degree of risk as someone that would not necessarily apply that degree of rigor. We think that leveling the playing field across the mortgage market is the most sensible approach and is ultimately the best tool to preserve the stability of the Canadian market.
Thank you. I'm going to go to Ms. Gee. Ms. Gee, in British Columbia, we have stratas. That's what we call condominiums, where someone will take shared ownership and they pay every month a strata fee. I understand you have something similar in Quebec. Is that correct?
Copropriété, yes.
Yes. Okay. Just so we're on the same page, that's what I'm speaking about. So earlier, Ms. O'Connell said, well, about people being pushed out of the market. Well, some people may stay in the rental market, and of course there's unintended consequences that will happen because that economic activity won't happen, Mr. Graham mentioned in his comments. But other people may find out if they have 18% less purchasing power, they may say, well, instead of buying a single detached dwelling, at a suburb, we'll go with a strata or a condominium. Now, oftentimes, this is the perverse reality of it, is there will be strata fees that end up being more expensive than than a single dwelling. And so this actually it puts more pressure on their household income, and they don't get what they want. Have you heard of this kind of thing happening?
I'm not necessarily convinced that this increases the cost for those who chose condominium ownership and strata financing. It depends on the region. And as you said at the end of your question, it's not necessarily the choice they'll make. If, for example, you're waiting for a second child and what you wanted was to be in a single-family home with a certain number of bedrooms, with a backyard, and you can't borrow the required amount of money, then perhaps you'll have to move to something else, something smaller, an apartment or a row house. But it wouldn't be your first choice that you would have willingly made before October 17th.
Over the years in Vancouver that made the decision to go to a strata because they just couldn't afford to get in the market. Now that's going to make it even worse for the next generation of homeowners. Mr. Graham, there's been a lot of talk about that we need to focus on supply and not just on demand. One thing that is within the Government of Canada's own sphere of influence on this is the GST or HST rebate on new home construction. Now, we want to actually start maybe talking about ways we can do it. Is that a possible way that the federal government could incentivize new home construction in a way that through the tax system?
Very much in the eyes of the Urban Development Institute and the Nova Scotia Home Builders Association. We both advocate for that. Over the last 10 or 15 years in Halifax, there have been increased regulations, there have been increased fees. We're trying to do our best to assess exactly what that amounts to in terms of the dollar amount that takes away from the narrowing profit margin for a house builder. And house builders have left the market because they've either willingly decided that they can't make any money in that industry in Halifax, and I'm speaking of Halifax in particular anymore, the biggest region in Atlantic Canada, or they've gone bankrupt. And so there are a number of fees, taxes, regulations that have culminated, and they come from a variety of different government bodies. They could be provincial or municipal, and they accumulate, and they've really taken a bite out of the profit, which allows people to stay in the business. So I'm very much in favor of that as an idea.
Thank you.
Ms. O'Connell.
Thank you, Mr. Chair. Mr. Graham, just following up on that, I do come from the GTA region outside of Toronto, so, we hear about the pressures in terms of building and the fees, etc. However, if we also have an issue, in this study we've talked a lot about people entering the market, but there is a difference between affordability of the average person and then people who just can't even afford a roof over their head. And I don't know the specifics in your province in terms of that ratio, but I'm just wondering, and this would be more of a provincial type approach or municipal type approach, but if there was an approach to look at reducing fees for the type of development, right? So if it was the type of affordable homes or accessible homes or high-rise for seniors and things like that, is that something that would be, whether through your organization or as a developer yourself, that a target of reducing these fees for that type of development, is this something that you would see that would be well received?
Yeah, I think it would. The Nova Scotia government in their last budget talked about an incentive plan that they were going to initiate. It's being modeled, it's very similar to the Newfoundland incentive that's being provided. British Columbia came out with one recently that's considerably more than what Nova Scotia is willing or talking about at this point in time, but a much lower percentage of the value of the home. I think those are good initiatives.
Thank you. So part of, again, drawing out these questions is that we do have to make recommendations, and the earlier panel talked about the working group with the federal, provincial, municipal governments. So those types of conversations are the types of things you see that regionally, how we can try and address from your side, on the supply side, some of the barriers for building these types of, again, targeted homes or apartments, whatever the case may be.
Yeah, there's a new president at Housing Nova Scotia who is very much interested in doing the things that you're talking about, and he seems innovative.
Thank you. Do I have time or? Okay, thank you. And I guess I'll just ask, I apologize, I don't speak French well enough to ask you a question, but feel free to respond in French if that's more comfortable. But I would ask you a similar question in Quebec. Where are those types of pressures on the supply side, and are there the types of incentives that through a working group and further consultations that you'd like us to see? Because the housing market is not just, you know, something that the federal government can control fully, and we've heard that testimony in terms of supply. Is there an area in Quebec that you see where, or would you agree, that incentives for, at different levels of government, to focus on actual affordability, people who just need homes or roofs over their head?
Well, there is the ongoing Parlons Logement initiative by the government, I think, and we hope is going to bring forward some of the, and address some of those concerns. I mean, looking at all consumer loans, I think, would be a great idea from our perspective, not to just look at mortgage rules in isolation, but just overall.
Oui, on oublie,
Quelque chose d'autre?
on oublie effectivement souvent.
Indeed, we often forget about the supply side of things because we talk about demand. That's always what we dwell on. And demand is strong because of the mortgage rates that are at an all-time low. But anything that could facilitate supply, the building of more housing units, affordable or not, any type of building, would be welcome. Any measures in this direction? We probably don't have the same types of constraints as those that exist in Toronto or Vancouver when the supply is perhaps more limited than it is in Quebec. It's one of the reasons also that explains why the prices of our homes is more affordable in Quebec. But clearly we're in favor of anything that might contribute further to more building.
Is there, does anybody want a quick closing statement? Or are we okay? All right, on behalf of the committee, certainly thank the witnesses for their presentations, their answering of questions, and their recommendations. That will wrap up this meeting. Meeting adjourned.
Thank you.